Good morning, everyone, and welcome to this meeting of the Pension Investment Subcommittee. I'd like to begin by welcoming members of the public who may be watching via YouTube channel and local pension board members observing via Zoom. Please note that there is no fire alarm test scheduled for today, so if the alarm sounds, I will adjourn the meeting and we will make our way downstairs and out of the main entrance. The nearest fire exit is through the middle doors to my left. The muster point is in the car park. Can I ask, though, that everyone present turns their mobile phones to silent or vibrate whilst the meeting is taking place? Okay. Item 1. Dawn, do we have any apologies today?
Apologies from Councillor Bowden, Chair.
Thank you. Does any member wish to declare any disclosable pecuniary interest or non-statutory disclosable interest? John?
John Walker. I'm a retired member of the local government scheme, and my son and daughter-in-law are both deferred members.
Thank you very much, John. Okay, so we move to item 2. We're being asked to approve the public minutes of the subcommittee meeting held on the 22nd of September 2022 as an accurate record. Can I ask if any member who does not agree with this proposal to raise their hand now? Okay. I see no objections to the proposal to approve the minutes as an accurate record, so I will take that as carried unanimously. Thank you. Okay, item 3, turning to the action log. Officers, do you have any comments or updates on the log?
There's 2 items that will be on the agenda for today, so hopefully we can complete those. That's the Blue Bay item and the passive options choices. Other than that, there's nothing further to add.
Thank you. Members, do you have any questions on the action log? I see no questions, so we will move on from there. Okay, we are asked to note the action log, and I assume we're happy to do so. Thank you very much. Item 4. Members, we have received 1 public question. The question has been circulated to committee members in advance of the meeting and is also available with the agenda and meeting papers on the County Council's website. Can I ask the Democratic Services Officer to read out the question?
Thank you, Chair. Thank you very much for your considered response. This refers to the question that was put to the September committee. We are pleased to hear that the committee is developing a plan to transition to a sustainable portfolio and welcome the fact that you have provided a clear climate action plan that the public can access. However, we think the scale of ambition is inexcusably unambitious given the scale of the issue and opportunity the Pension Investment Fund provides. Firstly, we would like to see a target for divestment from companies principally involved in the extraction of fossil fuels as part of the climate action plan, in addition to the decarbonisation pathway. And as there is a strategic review point planned for 2024, we think you should be working towards committing to immediate divestment following that. Why has no divestment date been committed to so far? Secondly, if possible, we would like to see a faster decarbonisation pathway and would like to know why decarbonisation by an earlier date of 2035 or 2040 has not been considered, and whether a date earlier than 2045 could be considered as part of the 2024 review. Have scheme members been given the option of decarbonising quicker? Your response regarding stewardship seems to focus on receipt of reporting rather than engagement. Please can you explain how the subcommittee influences the engagement priorities and what steps have actively been taken to influence the level of engagement and priorities? In our view, it is essential this approach can demonstrate having a meaningful impact to justify the engagement over blanket divestment approach. Again, we ask what metrics they intend to use to judge the success of this engagement.
Thank you, Dawn. I would like to thank, on behalf of the Pension Fund Investment Subcommittee, the Mothers Climate Action Network for making the time to make representations to this subcommittee. You will receive a written response to your questions within 10 working days, and this response will also be circulated to committee members and published on the website. Thank you. If we move to item 5, please. We will now consider the Cambridgeshire Pension Fund Investment Monitoring Report for the quarter ended 30th of September 2022. Can I ask Chris West to present this report, please? And if I could just sort of emphasise, we have got a fairly heavy agenda today, so if we can try and keep to the main point, the most important points, please. Thank you.
Yeah, Chris has delegated this one to me. Good morning, everybody in the room and everyone watching online. So, yes, you've got versions of this in front of you. So I'll refer to our page numbers and also the main pack numbers. So whichever version you're looking at, you can navigate your way through. So these are the numbers to the end of September. And if we cast our mind back to early autumn, we had the mini budget on the 23rd of September. And we know what the outcome of that was. We discussed it at the last meeting. It's been well reported in the news. Had a huge impact on the price of gilts and the gilt yield, which impacts the Cambridgeshire Fund in the sense that the value of the liabilities are linked to that gilt yield. So as the gilt yield goes up, the discounting that we give to future pensions increases. So the present value of the liabilities that we expect to pay out falls. So we actually saw through that for the Cambridge Fund an improvement of the solvency position, which is helpful. Some of the broader impacts that were well reported in the news, less impact on Cambridge, is just given the structural way that we invest in our time horizons and the way that we build the portfolio. Those issues were largely confined to corporate sector pension funds. So that's kind of the highlights. There were challenges in global markets that we can look at. If we move over to page 2 of the report or 13 of the pack, we can see the dashboard there that gives us some of the highlight numbers. So the top left-hand side there in terms of funding. So we can see the liabilities fell really quite markedly given that gilt yield movement. So down almost a quarter of £2 billion, which is a remarkable move. Now, the yield and the value of those liabilities were very, very volatile during that period. They'd gone up slightly from the peak of the kind of gilt crisis on the 27th of September. Those liabilities will have gone up again and then fallen again and then gone up again a little bit. So very volatile, moving around an awful lot. It's a helpful metric to look at there, but not something we pin ourselves to too much, given the very long time horizons of the Cambridge Fund. So that's what the liabilities did in terms of the assets, contracted marginally. So the performance of the total fund was minus 0.4%, so fell a little bit. Some of that gilt impact coming through, although our level of holding in gilt was relatively small. Global growth markets and global equities remain challenging as we saw interest rates rise and inflation staying persistently high around the globe, particularly for growth stocks. So the asset portfolio fell a little bit, but clearly not to the same extent that the liabilities fell. What that resulted in was an estimated funding level as at the end of September of 135%. So a very healthy position of the fund. It doesn't really fundamentally change what we do and how we invest. We are a very long-term investor. We need to take investment risk to generate levels of return in excess of the risk-free rate. But so it doesn't change fundamentally how we invest, but it does give ourselves a nice cushion to run a certain level of risk to be able to maintain that funding level. So it's a very strong position of the fund. In terms of the individual manager performance on the bottom left-hand side there, not too much to report, particularly over the shorter term. And so as I said, the fund contracted marginally. The benchmark was down slightly more, but pretty much in line. Given equities fell, that equity protection strategy that we have in place added a little bit of value, which was helpful. The private equity, less at the whim of market pricing and less volatile, held up quite nicely. We takes a slightly longer term for those performance numbers to come in, and we want to look at some slightly different metrics, but added a nice little bit of ballast to the portfolio. given the choppy waters that we've been through. Some underperformance from the global equity managers, you can see there in that bottom left-hand box, but clearly over a short period of time and relatively moderate underperformance, not of any great concern and nothing we need to look at. In terms of the longer term for the total fund, so again, contraction over the 1 year period, which is to be expected given the contraction we've seen in global asset prices and global equity, particularly, but still outperforming the benchmark, and then over the 3 year period, pretty much in line with the benchmark. And we have seen that improvement in funding, so the strategy is working well versus the liabilities. Asset allocation, largely in line. The fixed income portfolio has gone underweight by 2%, given those big movements we've seen in bond pricing over the quarter. We do have some cash sat outside the portfolio there, so you can see the £63 million in cash that came out of the equity portfolio. That is there to fund some of the illiquids. We need to have cash ready as those are liquid mandates call, so that cash is sat there. So that will be used for that purpose. It will also be used for a little bit of rebalancing as well to bring that fixed income allocation up a little bit. But broadly in line, and we expect those levels of deviation of the actual allocation versus the strategic. Manager research there is redacted given the commercial nature of it, but there are no material concerns that we have at the moment over any of the managers. Very quickly, in terms of the market environment, everything I've touched on in terms of slide 3, you can see there over a 3-month period, the charts at the top, and then over the slightly longer period, the 12 months at the bottom, you can see that contraction in global equities in the first few bars, and the green bars particularly, that contraction, that's investing in local currency. So for US equity, that is as a dollar investor, that's minus 4.8% over the quarter. You can see that blue box under US equities, that is as the sterling investor, that's plus 3.6. The difference there is the currency movement. So we did see, as you'll be well aware, quite a contraction in the value of sterling through that gilt crisis. What that means is a sterling investor investing in dollars, when the sterling value decreases in value, it's actually favorable in terms of the pound value of those assets that's coming through, because the sterling is worth slightly less. But hugely volatile moves in terms of the currency and in terms of the gilt yield there. So as we move through October and into November, and we got some more stability coming through and the new PM coming through, those gilt yields reverted and came back down again, which meant the gilt prices went back up and the liabilities went back up a little bit, but more stabilization in global markets. Clearly, we have the budget today, or the economic update today, which is happening in an hour's time. The hope and expectation from us as an advisor is that won't move markets too much, but let's wait and see. But given the amount of forward guidance or leaks that have come through in terms of what's going to be announced, we don't expect that to move the markets too much, but watch this space. I've probably cursed it by saying that. But risks in markets, market pricing generally down, challenging times ahead. As we know, the UK will probably be in recession. That will be a global event, given all the global macro factors that are going on and the geopolitical risk that we're all very aware of. So challenging times ahead. In terms of actions for the committee to take, we do have a strategy review coming up in Q1 next year, where we will look at a number of these risks and how we structure the portfolio. As a result of that, what we clearly need to be very aware of, that we are long-term strategic investors, so we don't make big moves based on short-term market events. We want to be very considered and very long-term in terms of how we build the portfolio. So that's the market move. On to slide 4 is the funding level and the value of the assets and liabilities over time. You can see up there the 135%. We would expect that to have come back a little bit as we've moved into Q4, but still a very healthy position, given the growth of assets that we've seen over the last few years, which is reassuring given we've been through a UK-specific gilt pricing crisis and choppy waters in terms of global asset performance over 2022. Reassuring to know we're still in a strong position. On to slide 5 quickly is the asset allocation at quite a high level. So broadly in line there, as I said, the fixed income slightly underweight that we'll look to rebalance at an appropriate time, but pretty much in line with the strategic asset allocation, something that we'll want to keep an eye on given market pricing is moving around an awful lot. Slides, so pages 6 and 7 and 8 or 17, 18 and 19 go into that in a more granular detail in terms of the value of each of the mandates versus and their allocation in the portfolio versus the benchmark. Won't go into those into any level of detail, but happy to take questions on them. Where I will finish this presentation before we open it out to questions is a little bit of commentary on performance, which comes through on pages 9 and 10 or pages 20 and 21 of the main pack. So as I said, not too much to report in terms of the equity there. We see some volatility in terms of the performance of our equity managers versus the benchmark, a little bit of underperformance coming through. Clearly 3 months is a very short period of time. And not a period of time that we're going to judge those managers over. The longer term performance looks slightly stronger. Long view, we still have under enhanced monitoring that we talk to officers an awful lot about, and we will continue to do so, but no red flags or no updates, certainly from the last time we gave you an update on that. The UBS passive portfolio is something we'll discuss in part 2 to be able to put an ESG tilt to that mandate and help us on our decarbonisation pathway, which is a very helpful strategic move in aligning the portfolio with our ambitions and strategic requirements on decarbonisation, climate change risk and ESG more generally. Fixed income portfolio there, you can see that Schroders bond mandate, some pretty big negative performance there. That is invested in the UK gilt market as a buy and hold type mandate. So we just go out and buy some gilts and just keep hold of them. There's not any active management in there. So that's fallen in line with the market and just gives you a sense of how much that gilt pricing moved around over the course and how much the price of gilts contracted over the quarter and indeed over the longer term, because we had seen long-term interest rate expectations go up over the course of 2022, given the inflationary environment that we're in. The Blue Bay mandate there, some pretty material underperformance versus the benchmark. That is a long-term fixed weight benchmark, effectively, not an asset class type benchmark. So you do see those big deviations, particularly when you've seen the big market moves coming through. Had some impact of kind of broader credit pricing and interest rates rising, which is why the performance is negative there. Again, not something of material concern over a shorter period of time, and actually defaults in that portfolio have been very low to zero, so we're still very comfortable there. M&G, a very similar mandate to Blue Bay, but takes a lot less risk strategically and deliberately so, which is why the performance has been stronger, but still negative coming through there. When we move on to the final slide, which is 21, which goes into the alternatives type mandates. As always, we say the performance here is to be is important, but there are different metrics we want to look at and more in-depth reviews we want to do of these assets in there. So not too much to report given that and given the illiquidity there. Just one number that does jump out is the Allianz Infrastructure Debt mandate, which is minus 12.3% over the quarter or minus 22.1% over the quarter. So that is lending to infrastructure projects. And the way these funds are structured is they are closed-ended. So you deploy some capital, they go out and find projects to lend to, which has a life cycle, and then you start getting the money back as that debt is repaid. Well, what that happens is when you get towards the end of the life cycle, those portfolios end up quite concentrated. And you get some big performance moves. So a relatively small part of the mandate now, it's around 0.3, 0.4% of the total fund. There's only actually 3 assets left in there, which are all transport type assets, which are quite cyclical. And obviously that means it's quite concentrated. So given a small base, quite a concentrated portfolio now, that's why you're seeing some of those big performance moves coming in there. But when you aggregate that up to a total fund out level, relatively muted. So again, it looks like a stark number, but we're comfortable there. And again, the infrastructure part is something that we'll want to look at, given some of those funds are in the later part of their life cycle as part of the forthcoming strategy review. So a bit of a whistle stop, hopefully gives you a good flavour about what's been going on, risks on the horizon, things that we'll look at as part of the strategy review, but I'll stop there and see if there's any questions.
Thank you, Peter. Always confusing to me who's going to speak. Members, any questions that you'd like to raise? Any items you'd like clarity on? Seems fairly quiet. we could be coming back in 2 hours' time asking for an update on this, judging by what happened last time. Okay, yeah, I'm assuming that, you know, while we're, you know, the bond yield obviously has a major impact in terms of, you know, the net present value of the future invest or future liabilities. What's actually more important is actually the relatively small movement that there's actually been in the fund value over the quarter.
Yeah, exactly that. And there are other metrics that we like to look at as part of strategy reviews, and inflation risk and cash flow risk and all those other things are important things as well. So yes, and but certainly kind of, I guess, for any members of the fund that are watching online, it could clearly be a concerning period given the news reporting during that period and the kind of broad brush reporting on pensions. And there were some specific issues with corporate DB pension funds that doesn't really map over to the LGPS and LGPS funds generally, and the Cambridgeshire fund particularly was not particularly impacted by that gilt crisis.
I think basically we're saying that we've weathered quite a bad storm reasonably well over the last, whatever it is, 6 months. Okay. Thank you very much, members. If you've got no comments, then we're asked to note this report. I assume we're happy to do so. Thank you very much. We move on to item 6 then. We will now consider an update on the stewardship and engagement. Can I ask Ben Barlow, Funding and Investments Manager, to present this report?
Thank you, Chair. Yeah, this is the first time we brought this report to the ISC, and it's one that you'll probably start to see and know and love quite well, hopefully. It's something that we'll probably start bringing every 6 months, or we hope to. We're a bit ahead of the LGPS curve on this report. This is something that we need to do as regulation, is start to report on our stewardship and engagement. Why are we doing it? The Cambridge Pension Fund recognises the importance of promoting good governance and management in the companies in which the fund invests. The fund expects investment managers to exercise voting rights and engage with companies with the aim of good stewardship of the fund's assets. So we're just reporting on how they're doing that for us. Ideally, they need to follow guidelines that Access have agreed, and they're agreed at the Access Joint Committee when they're doing these voting. So there's 2 areas within this report. There's the voting itself. So to break that down, there was 128 meetings this year. Of those, there was a total of 212 voting opportunities, or where they were asked to vote for or against manager proposals. 1,581 were voted for, 378 against, and then there's 53 other where they've abstained from the votes, basically. None of those were against Access guidelines. That's not to say there wasn't any occasions where there's been a vote against Access guidelines, but in those occasions they were Access funds where Cambridge Pension Fund wasn't involved. The second part of the report is around the engagement. There is a table summary on 4.2 in this report. I should say there's a lot of information, and this report is very much a summary. If we'd added an appendix, it would have been 3, 4, 5 times as long. So that information is available on request. And, you know, as we're saying, this is the first time we've brought the report. So if you feel that we haven't got the balance right between summary and actually detail, that's something we can tweak. But to give you a flavour of engagements, there was one example in there. There is a table in there that shows what engagements there has been. But to give you an example of one of them, company Henry Schein, hope I pronounced that correctly, who Longview invest in, they signed up to a net zero agreement by 2015 based on science-based target initiative. Longview were happy with that, obviously, but they just wanted a bit more detail behind the metrics they were using and reduction targets within that, similar to our own climate action plan. You have targets within that. The company has pledged to do so, and Longview are monitoring that. So that's just an example of the kind of engagements we would have that we do have, again, within our appendix that we can add if you feel that detail is needed within this. But as I said, there's a lot of detail, and it could be a very long report if we went to summarise slightly. With that, I'm happy to pass over to questions.
Yeah, members, this is obviously first time you'll have seen all of this data in this particular way. I hope you've had a chance to sort of have a look through it all. I think the intention is that we're actually demonstrating the other side of things, in that the actual way we're using our investments, hopefully in a positive manner, or certainly within the objectives that we have. Are there questions that anyone has about this report? No, everyone seems very quiet today. Mark?
Not a question, Chair. Just a comment on to give a flavour of the work we do as officers. So we obviously sometimes managers come to committee, but we often have quarterly updates with individual managers, certainly the main ones within the fund, and we'll discuss engagements there in some depth, particularly if there are new companies that we concerned about, and you know what their approach to those are, for example. We have meetings within Access, so there is a rolling programme of each investment manager coming to speak to Access, and again, one of the topics of discussion is always permanently around things like climate action, around engagement. There's obviously also the investment seminars which Access run. I think they tend to be every 6 months, whereas certain managers come there. So committee members also have the access to those as well. We'll have ad hoc meetings. And then I think in that report, LAP is another really important part. So this collective engagement that takes place on our behalf. So we're a member of LAP. LAP can engage with any company that any of the LAP members own. And you know, there are many of the many of the local authority funds are LAP members. So it's really important just to give a bit of a flavour that there's a lot going on under the hood, and we can bring any of that. And yes, what Ben said about the detail, there is effectively a narrative about every single engagement that we get. So the original version of this report would have run to about 16 pages if we put all of those updates in. So it is, I think it is just getting the balance right as to what you want as committee members in terms of that detail.
Thank you for that. I think this is, actually going back to the question that was originally asked, one of the points in there was around, what are we actually doing in the engagement, and can we demonstrate it? So I think that this is quite useful in being able to demonstrate that. I think what's really important is that point as to how much detail we go into, how much detail means something to us all. So perhaps members, you could think whether or not this is the right balance of detail, whether it's a little bit too much or whether more is needed, and perhaps we could take that discussion offside. Ben?
Yeah, just to say, if there is any comments, you're welcome to email me and I can build that into the next report.
Thank you very much for that. On that basis, we are asked to note this report, I believe. So are we happy to do so? Thank you very much. And thank you very much, Ben, for bringing to us a new way of looking at things. Okay. So we'll move on to item 7. The following items on the agenda are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from consideration of the following items on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and that it would not be in the public interest for this information to be disclosed, information relating to the financial or business affairs of any particular person, including the authority holding that information. May I ask if there is general consensus in support of the recommendation so that the subcommittee can take it now? If anyone disagrees, please indicate. Thank you. As the committee has resolved to move into private session, we will now close the public part of the meeting and stop the live streaming via YouTube. I'd like to thank anyone who has been watching this today. The next meeting is on the 23rd of February.